Welcome to DELUX. Rich people avoid paying taxes in these 15 ways. Number 1. Invest all of it. If you're wealthy, you don't hoard money unless you absolutely need it to accomplish a specified goal. When it comes to taxes, this is the golden rule. Reinvested profit is not taxed. The end of the year was fast approaching, and your company was on track to achieve a profit of $5 million this fiscal year. You decide to reinvest those $5 million back into the company in order to grow it even further. The $5 million are exempt from taxation. That's how fast businesses grow. Net worth rises as the owner of the company, with little or no tax to pay. Number 2. Everything you use is owned by a business. Another tax optimization rule to keep in mind is, all of your expenses should be taken out of your income. Basically, if you're running a business, you don't owe any taxes on the money you spend on necessities. Are you looking to buy a new car? As far as I can tell, both my employer and I need the vehicle. So, since you require it in order to run your business, enable the corporation to purchase it on your expense. Things that the wealthy deduct. Regardless of what kind of technology it is, hardware, software, etc. Everything from laptops and smartphones to gizmos is required for the firm. For business visits, lodging and transportation are essential. Health insurance rates, internet access, and other necessities for a home office. The cost of dining out is deductible. The less money you have to pay in taxes, the more you can deduct. Number 3. Move somewhere with little or no tax. People frequently underestimate the magnitude of the impact of relocating to a new location. The impact on your life that not spending your money would have is immeasurable. This used to be the standard procedure. Dubai, Monaco, and the Cayman Islands would be your new destinations of choice, or the Bahamas as your primary residence. There is no income tax in these nations. No tax is due on the money that you're making. But there is a catch. It's usually really expensive to move there, hence why the rich get an unfair advantage in life. The cost of living in Monaco is also incredibly high. Number 4. Send it overseas. This is the way Facebook, Google, and Apple do it. Because of Ireland's tax-friendly environment, they set up businesses there. The intellectual property of these companies is theirs. Ireland requires a licensing fee from the American company per year for the company to continue product development and sales in the United States. The U.S. corporation was able to claim a legitimate deduction as a result of this. They're shifting money out of the American economy and into the Irish economy through this plan. At a point where even more optimization results in a savings of only 1% or less. In countries with low income taxes, you can always set up a local business and reap the benefits of lower taxes. Reimburse your U.S. subsidiary for services done so that your U.S. tax burden is kept to a minimum. It's preferable for companies like this to pay a fine than to pay all of their taxes. There is a lot more to it than first meets the eye. A fine is a form of punishment for breaking the law. Taxes are penalties for doing the right thing. Number 5. Charitable donations. Fifth rule of taxes. Donations to nonprofit organizations are not taxed. This is why everyone who is rich has some form of foundation. In the state's defense, it has a history of mismanaging its financial resources. So instead of giving it the money to do with it as it pleases, you're better off using a charitable foundation to make sure your money actually has a positive impact on your community. The fascinating part is that even these tax-exempt foundations have tax-deductible expenses. Things are essential for their survival. You can even donate land, vehicles, or other assets to a charity you own, and it still counts as a charitable contribution. Also, as the head of the charity group, you can still use the same car that you donated on paper. Number 6. Instead of receiving a salary, they accept stock options. Queen Bey said it best. Pay me equity. There are 2 reasons for this. Over time, the value of equity may rise. Unless you sell your equity, it is not subject to taxation. And that's exactly how Elon Musk amassed his massive fortune. Elon's annual salary ranges from $0 to $23,000. That's exactly how much Elon Musk makes a year as CEO of Tesla. Elon receives newly issued shares instead, based on the company's performance. Tesla's stock price has risen dramatically since it went public, and his net worth is expected to soar even further. Number 7. Buying art. Here's something only the rich know. In the final major unregulated market, it is the art market. You can deduct the cost of art purchases from your income, and if you've been paying attention, by now, you should be aware that you can deduct a significant amount of your expenses. That being said, the wealthy are well aware of this. You make $1 million this year and spend it all on a $1 million artwork. How would you spend it? There is no tax to be paid because the expenses are equal to the income. 3 years later, the same painting you possess is worth at least $6 million. It is the opinion of a qualified appraiser. To a museum, or even better, you opt to give it away rather than sell it for profit. To your art foundation, tax deductions of up to $6 million are now yours. You just saved an additional $5 million, assuming your annual salary remains at $1 million. All of which is permitted by law. Even if you don't want to, you can always play another game. Consider selling the picture for $6 million and making a profit of $5 million. That agreement, which should be taxed, isn't, is it? Once again, the government comes to the help of the super wealthy. If you spend every penny from the sale, all $600,000 of it, on new artwork, no taxes are due on the profit you've made from the sale of your property. That's why the rich buy art. Number 8. Multiple nationalities with no fixed residence. More than one nationality living in the same place at the same time. People have done this, even though it's undoubtedly the shadiest and most confusing one on the list. You must pay taxes in the country where you live when it comes to taxes, where you grew up. But what happens when you no longer have a country of origin to return to? There are plenty of super wealthy individuals that choose not to have a home country, despite owning properties all over the world. When institutions want proof of address, they send one from a property they own in Thailand or Bhutan, which is written in a different language and ignored by a government that has no intention of releasing any extra information. When it comes to primary residences, there are those who purchase a big yacht and use it as their main residence. As a result, you may find yourself in international waters one day and moored on Monaco's coast the next. Having more than one nationality is recommended so that you can take advantage of the benefits of numerous passports. As a long-term solution, we don't think being completely off the grid is the best option. Number 9. Gift money away. Do you know that you can give others gifts? The gift is tax deductible, as well? Isn't it crazy? Even yet, the gift has a $15,000 limit. It is okay if the donation is less than $15,000. In this case, the IRS does not need a record of it because it is not taxable. You could be thinking, cool, but this is a video about really wealthy people and how they maximize their wealth. In terms of gifts, $15,000 barely gets you into the Rolex game. Although $15,000 may appear to be a large sum, there is more room to move. The lifetime gift exemption in the United States is restricted at $11.7 million as of 2021, as long as each contribution is less than $15,000. $11.7 million in tax-free wealth is equivalent to a slew of Rolex timepieces. Number 10. Hold it in privacy coins. If you want to keep it private, put it in privacy coins. Cryptocurrency is revolutionizing the transfer of wealth and the protection of capital. Putting $1 billion on a stick, sticking it in your pocket, and flying around with it is a remarkable feat. To travel to Singapore with it is an experience that is truly out of this world. To protect the likes of Bitcoin and Ethereum, precautions have been put in place. To ensure that everyone is paying their fair amount, link wallets to persons. But there's more to it. The rise of blockchains has given way to a new breed of technological currencies called privacy coins. Anonymity is guaranteed when exchanging, storing, and transmitting these tokens. Privacy coins are not illegal, but their legality in each jurisdiction is still up for debate. Monero, Dash, and Zcash are the most popular cryptocurrencies. Number 11. You have no money but you have assets you can borrow against. Here's why most wealthy people have a lot of money but not a lot of cash. You must pay taxes on any money you take out of your enterprises in order to do so. People who are extremely wealthy often make the conscious decision to never touch their funds. If you don't need it, you can keep it as a stock or asset. However, there are times when you'll need money. That's where the relation you have with your bank comes into play. Rich people walk into banks and say, Look at all of my possessions, including my cars, my assets, and my stock holdings. If it comes down to it, I'll take a loan from you. The bank examines the portfolio and provides quick cash to wealthy clients whenever they need it. They aren't required to pay taxes because this is a loan, and they only have to return the money they borrowed. If everything is done via a corporation rather than an individual, this mutually beneficial connection can last for decades. Number 12. Filing for bankruptcy. Unless you're incredibly affluent and know how to get out of it, filing for bankruptcy is expensive, time-consuming, and confusing. Here's a breakdown of how it works. What if your salary is $250,000 per year as a competent lawyer? In addition to owning a $1 million home, you have saved $1 million. Buying a $10 million office facility is your first step towards starting a new company. Because it's going to make you a lot of cash, your $1 million is deposited in a bank account. Purchase the office building with a $9 million loan. A pandemic strikes a year later, and all of your tenants are forced to vacate. You still owe $9 million to the bank. Adding insult to injury, the building you just acquired is only worth $5 million. Nobody is interested in purchasing an office building. Our lawyer is now able to file for bankruptcy because the office building is held by a corporation. His residence and earnings are safe from bankruptcy rules, despite the fact that they'll remove the office building from him and he'll have a hard time ever working again with the bank. This is the difference between being poor and being broke. In other words, even if their net worth is zero or even negative, a rich person might nonetheless be broke without actually being impoverished. Since the bank was unnecessary and the money was paid out in cash, the loss would still be deducted from your taxable income for many years to come until you recoup the money you spent on it. Number 13. Claim your yacht as your second home. When it comes to taxes, there's an interesting tidbit. Governments adore homeowners and loathe the extravagantly wealthy. There is a strong desire to tax these show-offs. #tax the rich is currently trending on the internet. Is there anything that the wealthy can do about this? As if their yachts were second homes, they claim them to get better taxation rates. It's true that they're utilizing it as a vacation home when they're traveling to Mykonos during the summer. The IRS treats the boat as a second home as long as it contains sleeping, cooking, and bathroom facilities. Motorhomes can be utilized in the same way. However, how many super rich people are actually purchasing these items? Number 14. Using a trust to avoid paying estate tax. There's a proverb among the wealthy that goes something like this. People don't realize how fortunate they are until they have to pay taxes on their wealth. If you're not wealthy, you may not know this. If you're wealthy and you die, your assets will be transferred to your heirs. If you want to leave your children a portion of your money, the state taxes up to 45% of it. An estate tax is the name given to it. You know what? Here's something you should know. If you're worth more than $11.7 million in the United States, you're considered wealthy. There is no estate tax or a significantly reduced estate tax for someone worth less than that. The way rich people are structuring their wealth in order to keep the state from taxing it away is by using trusts. Things are no longer yours if you place them in a trust, so long as certain conditions are met. You can't give them to your children because they're not owned by you. For inheritance tax reasons, once the property is kept in trust, it is no longer part of anyone's estate. As a result, it prevents you from transferring all of your assets to your child's name. Because they have the ability to quickly blast through it, the power remains in your hands as long as you are still alive. You may even create smart contract-like guidelines for your children to gradually gain access to their assets in the trust, under specific conditions, such as when they reach the age of 25 or complete their education. Number 15. Depreciating assets on paper to outweigh the cash income. To become wealthy, you must learn to speak the language of money, accounting. It's important to be able to speak or at least understand the language. In simple words, depreciation is a tax deduction that allows a firm to deduct the cost of an investment, such as a car or a machine. Over time, it's dispersed across the investment's lifespan. For tax purposes, distributing deductions is a good idea, to ensure that a business can replace the property at the end of its life. The cost of property is calculated now. Let's say you buy a factory for $10 million and intend to use it to make those ugly-looking face shields for the next 10 years. In accounting terms, the factory's worth decreases by $1 million annually. If your face shield's sales revenue is less than $1 million a year, taxes can no longer be levied on the remaining revenue. Accounting-wise, equipment, vehicles, and even offices can be depreciated, allowing you to continue paying less and less tax. If individuals understood how to manage their money effectively, their businesses would develop at a far quicker rate, allowing them to hire more people and generate better goods. You are not obligated to pay more taxes than what is needed by law to do so. Even while taxation was intended to benefit the poor, the privatized and optimized for profit, it doesn't function as expected. We'd like to know if our viewers come from all over the world. In your country, what percentage of your income is taxed? In the comments below, we'd love to hear what you have to say.